My name is Jake, welcome to the channel. In today's video, I want to talk about how you can know if your dividends are safe or not. I have conversations with a handful of people, and whenever we talk about individual stocks, I'm hearing more and more this year, more so than the last couple of years, well, is the dividend safe? How do you know if the dividend is safe? Are they going to cut their dividend? I get asked this question all the time, whether I'm talking to somebody that is maybe a little bit more experienced or a little bit newer to dividend investing. This is a common question that gets asked normally, but even more so when you're watching the market go down, when you're seeing this volatility in the stock market. Nobody wants to lose money. Nobody wants to make the wrong decision. And in this video, I'm going to share with you how you can uncover whether or not you're investing into a company that may be at risk of cutting their dividend. Now, this is no one size fits all approach here. There's a lot of things that go into play. It can be anything from the management of the company. It can be, macro or microeconomic factors impacting the business's ability to grow their top and bottom line. There's a lot of things that go into play here, but I want to dumb it down, make it really easy to understand, and share with you some things that I think about when I think about dividend safety. And to be very honest, I wish I would have seen a video like this 5 years ago. I wish this would have been one of the first videos that I watched when I first learned about dividend investing, because that was on my mind. Well, it always felt like, rolling the dice. Are they going to raise it? Are they going to cut it? What's going to happen? I'm going to share with you some things that you can do to see if you're invested into companies, businesses that are sustainable and that maybe are in risk or not at risk of cutting their dividend. So for the remainder of this video, I'm going to focus on four things. I'm going to focus on first, dividend history and how important it is, but it's not the only thing that you should be looking at, and it only tells half the story of whether or not a business is going to be able to continue having that wonderful history of dividend increases. The second thing is I want to talk about economic moats, why they're important, what to look out for, and just really briefly touch on that topic. The third thing of this video, I want to talk about understanding EPS, earnings per share. That's going to be the bulk of the video. I'm going to go in and I'm actually going to show a comparison of companies like Microsoft versus IBM. I'm going to show Waste Management versus 3M, and I'm going to show S&P Global versus Ben Franklin financial companies. So 3 different sectors, 6 different companies. I'm going to dive into that. And then the last thing, while looking at the earnings per share and the dividends, I want to take a look at the payout ratio and the fluctuation per quarter and some things that you can look out for when you're investing in individual companies. The volatility is real that we're seeing in the market. I don't know when it's going to stop. I don't have a crystal ball. But what I can tell you is if you're investing in the stock market this year and you're new to investing, it probably feels a little like this. Oh my gosh. Oh, it's a masterpiece. Oh, I love it. I love it. It is so true. I don't know, man. The world is in a crazy place. If you want to follow me on Instagram, I'll leave a link in the description below. You can check out my page there. I like to, post things about once a week or so. Just all about dividend investing and all that fun stuff. All right, so the first thing here, if you're looking at dividend safety, there's really kind of some simple ways to do this. You can do it on your own. You can pay for a service. There's a company called Simply Safe Dividends. They offer a service that you can pay for. What they're typically looking at is they have an algorithm or a process by which they view dividend safety, and some of it is unique to them. Some of it is just generic based off of cash flows. This is something that you could consider, though I am not a big fan of the price. $500 a year for dividend safety scores is a little bit steep. I personally don't use this. I personally don't recommend it. I mean, I don't know, to each their own. Another way that you can do it, you have in Seeking Alpha, you have the dividend grades. Now with the dividend grades, it's more so just focused on cash flows, debt to the debt levels, the payout ratio, those kind of metrics. So when you look at the dividend safety, you can see all the numbers here. And I'm sure like 80% of those of you watching my channel, you probably are like, this is a lot of numbers, and what do I look at, what I focus on? And the majority are probably going to just look at, the dividend growth grade, right? Does it have a good grade? What are the grades down here? What is the safety? And so those are a few ways that you can kind of look at it from an all-encompassing view and just get a grade or a score. But more so in the video today, I'm going to walk you through really looking at the earnings per share, the dividends per share, the payout ratio, how you can factor that and how you can calculate that. But I do want to say I share a lot of stuff on Seeking Alpha. I absolutely love Seeking Alpha. It's no surprise to anybody that's been following the channel. A lot of the stuff that we're going to view in here in terms of the financial statements, income statements, it's going to be dating back, years and years ago. So some of this you're not going to be able to do on your own unless you have the premium version. For example, the grades and stuff, you're not going to be able to see that without premium. But I would never recommend something that I don't use. I use premium. I love it. I use it every single day. I will leave a link in the description below. You can get 58% off. Instead of paying, $240, you'll pay $100. And believe me, it is a heck of a lot cheaper than paying $500 a year for something else. But that's just my opinion. So to start off, I love this quote from Mark Twain. History does not repeat itself, but it does rhyme. When you look at charts, when you look back and you see performance of different companies, different indexes, and see how they perform during different economic times, you'll notice that not every single correction is the same and it doesn't repeat itself, but it does rhyme. And it's really interesting to see that. And I want to make a focus on that. If you're new to investing, in the moment, it can feel really scary, but if you zoom out, the market has been correcting since its existence. Like we've had ups and downs in the market for forever. Every gray line here is a market downturn, is a recession. And we've had dozens, right, over the last 100 years or so. So, and to look at this in a different way, I like looking at this view because it sticks out a little bit more. You can see the green years, you can see the red years. This red right here, this is this year, this is in 2022. Back during the financial crisis in 08, the market was down 38%, right? So in, just looking over the last, 100 years or so, the market has seen these drawdowns of 20, 30, 40%, a handful of times. And when looking further back in history, you can see that the market is going up and down. You can see that, back in the 1800s, they were having other issues in the world besides the issues that we're having today, right? The economy looked entirely different. Globalization was not necessarily a thing back then. But you can see, despite what time frame you're looking at, the dividend yield, the actual dividend that we're getting paid, it's changing, it's fluctuating over time. But I love this chart. If you ever feel concerned about the future outlook of what the economy is going to look like, what the world economy will look like, look at this. Over the last 100 plus years, the S&P 500 dividend, the amount of dividends being paid has continued to go up and to the right. Now, if you were to zoom in during, specific times, then yeah, I'm sure back in the 1930s, the 1920s, it felt like, the world was going to end. But just remember, history doesn't repeat itself, but it does rhyme. Now, a couple of things that I want to take a look at is I want to look at a few examples, and then we're going to dive into the economic moats, and then we're going to dive into the examples of the EPS and the payout ratios. Okay, so stick with me here, all right? So first off, I want to take a look at General Electric, right? If you were investing in a General Electric during the 1990s to early 2000s, you were feeling probably really good. You were, if you were investing in 2003, you're looking back, man, General Electric has increased its dividend every year these last, couple of years. I'm feeling really, really good. But things change. Things can change. The management can change. Competitive, new companies, can come up, and incumbents like General Electric can really see resistance. Okay. And let me give you another quick example with Ford. You imagine you're a dividend investor just invested into Ford, right? That's why we diversify. But as you can see, dividends are never guaranteed. Really quick, I want to touch on economic moats. When you're investing into a company and you're trying to gauge the dividend safety of a company, well, you have to ask, well, does this company have a moat? Are they protected against, external external competitors coming in and stealing market share from them? And so when looking at the Morningstar economic moat rating, there's really just, a couple of different factors that you really want to consider when you're investing into a business. First, there's a moat when it comes to the tangible assets of the business. The second, it could be switching costs. How difficult is it to switch? Companies like Oracle and Microsoft are incredible when it comes to setting up switching costs and making sure that companies cannot easily just switch. I'll give you a really quick example. Zoom video, right? How quickly did Zoom video skyrocket during the pandemic? And what has happened to them lately? There's no moat. There's no moat with Zoom. However, with Google and with Microsoft offering services comparable to Zoom, maybe not as good, debatable, there's no switching costs with Zoom. And that is absolutely critical when you're looking at the viability of a company long term. You can look at the network effects, the cost advantages, and the efficiency of scales. So I'm not going to dive into this further, but it's absolutely important when you're thinking about the dividend safety, when you're thinking about a business, how easily can another company come in and steal market share from the business? All right, that's what you want to think about. Okay, for the remainder of the video, I want to go in and I want to get really nerdy and I want to look at the numbers. Okay, so if you're just going to try to follow along here and just kind of listen on your phone, maybe kind of like a podcast, I'll try to do my best to make sure that I outline the numbers, what we're seeing on the screen here. But the remainder of the video is going to be very informational. I hope that you're going to learn something from this, because if you're a new investor and you're investing in individual stocks, and if you don't know this, there's a problem. If you don't follow along and understand this, you probably should not invest in individual stocks. You should only invest into ETFs. Okay? And if you watch this and you do understand it, then you have my approval to invest into individual stocks. Okay, so first things first, what I want to look at is, so we're in Seeking Alpha, I want to look under the Financials tab. Now, once again, you're going to need the premium version to gather all the data from years back. Now, I believe you can get this, I think, for free with Yahoo Finance. I don't want to, so just however you need to get the data, you get the data. I like Seeking Alpha because it's simple and it's all in one place. All right, so what we're going to do is we're going to go into financials and we're going to look at the income statement. And what we're going to do is we're going to compare Microsoft versus IBM. Then we're going to compare Waste Management versus 3M. Then we're going to compare S&P Global versus Ben Franklin, okay? So the financial company. Those are the things that we're going to do. The first one here with Microsoft, I'm going to explain everything that I'm doing and I'm going to go through it slowly. And then as we go on, I'm going to get faster and faster, because by then you're going to be an expert. Okay, so we're going to go over the income statement. Now, a couple of things that you can do. You can either do it annually or quarterly. You can do it absolute, or you can do it year over year growth in percentages. I'm going to show you a few things that I look at. When looking at this, the dividend safety, I like the annual view when looking at it just kind of like big picture. When you're really concerned about the dividend safety, I would encourage you, look at it quarterly. See what's happening quarterly. If you're just kind of like broadly checking in, okay, how is Microsoft doing? You can do it annually. But if you do fear that a company that you invest in is at risk of cutting their dividend, go in quarterly. Okay, and I'm going to show both. All right, so first things first, what we're going to do is we're going to scroll down here and we're going to look at the basic earnings per share, so EPS. Now, earnings per share is the earnings. Now, growth stocks, unprofitable growth stocks, they don't have earnings. They're unprofitable. So they're not going to be paying a dividend anytime soon, okay? However, cash flow positive earnings, companies that have an EPS, they have revenue, they have earnings that they can show their shareholders. And the thing that I want to look at is I want to look at yearly, how has their earnings per share grown year over year? And I think, let's see if I have the camera here. I guess, the screen share, you can see it all the way from 2014, 2013, you can see there. Okay, so you can see on the screen here, you can see the EPS, the basic EPS has continued to grow, consistently these last couple of years. It's really expanded. Here, let me go back and show you this. It's really picked up since 2019. Okay. Now, another thing that you can look at the diluted EPS. It's a little bit different in terms of the financial gymnastics and how the reporting works. But you can either take your basic or you can take your diluted, however you want to do it. The next thing that I want to look at is dividends per share. Okay, so the dividends per share, this is once again annually, and we'll look at this quarterly in a second. You can see annually that it has grown every single year. So a couple of things. Basic earnings per share is growing, except for in 2018, there was a dip here. But the remaining years, they've all been positive up and to the right. Okay, and also you can see that the dividends per share have also gone up. Okay, very, very important. Now what you want to look at is the payout ratio. The payout ratio is what is paid, so the dividend that is paid from the net income, the earnings of a company. So generally you want to see a lower payout ratio. If you see a payout ratio over 100%, that is a huge red flag. Okay, unless you're looking at a REIT, a real estate investment trust. I'm not going to go into REITs in this video. With REITs, you don't look at the EPS. Don't look at EPS. It's irrelevant. Look at funds from operations. Okay, so don't look at EPS. But I don't want to confuse everybody. Let's just stick with normal companies here. All right, so you can see here in 2018, the payout ratio for Microsoft went up. I bet back in 2018, people were thinking, ooh, that is high. What is going on? And then back in 2019, maybe they had an acquisition, maybe they did something. I don't know. If you're concerned, you'd have to take a look at it and you'd have to dive deeper. But at a high level, you can see here that the payout ratio has been very healthy. Now, healthy can mean something different depending on the business. A technology company like Microsoft generally should have a lower payout ratio. A utility or a consumer staple can have a higher payout ratio. A utility could have a payout ratio of 80%. A consumer staple could have a payout ratio of 60 or 70. A sin stock could have a payout ratio of 80%. Okay, when you get over once you get into the 90% range, that's scary. Once it's over 100%, what that means is the company is paying shareholders a non-sustainable dividend. Okay, it's unsustainable. So if a company's paying more out to shareholders in a dividend than they're bringing in earnings, there is an imminent dividend cut in almost every case. The only way they can avoid it is, for example, if they do some shenanigans where they take on more debt or they sell off assets. But you don't want that. Do you want that? Do you want to be invested into a business that's gutting itself so that it can pay you an unsustainable dividend? I didn't think so. Okay, so couple of things to recap here. The earnings per share, it's moving in the right direction. It's moving up and to the right. The dividends per share is moving in the right direction, up and to the right. The payout ratio is moving in the right direction. It's down to the right, down. You want to see the payout ratio go down. Okay, so this is annually. Let's take a look at this really quick and let's take a look at it quarterly. Okay, with quarterly, let's take a look. Now, once again, the quarterly view is great because you can see really what's going on now. What AT&T was doing 20 years ago doesn't really concern us really today, right? The economic factors considered today are going to be pretty different than 20 years ago. Okay, though the only caveat there is what were they investing 20 years ago to impact their business today? So that is kind of research and development, all that fun stuff. All right, let's look at it quarterly. Quarterly, their EPS has stayed fairly consistent for the last couple of years, has not really gone down significantly. This is why the market is crashing, by the way, everybody. The market believes that the earnings per share for companies is going to go down. So the market is saying that the EPS for Microsoft is going to go down next quarter. That's why the market is selling off, by the way. So in case you were wondering, there you go. There's your answer of, with interest rates going up, all that stuff, the assumption is the market is assuming that the EPS of businesses are going to go down. Okay, so that's basic EPS. The next thing that we're looking at is dividends per share. Dividends per share is still continuing to rise. Right now we're looking at 2 years here? So 2 years of data versus like 10 years in the last few. So the growth is not as exponential, but you can still see that it's moving in the right direction. And then the last thing here, the payout ratio. Payout ratio, you can see that the payout ratio is going down. Let me show you how you can do this. Let me show you really quick. Let me see if you can see the screen here. So you got the dividends per share. Let me show you how you can calculate this. You got dividends per share, 0.62. So I'm looking at December 2021, 62 cents in dividends per share. And I want to divide that by the basic EPS of 2.5 divided by 2.5. That gives me 2.48. 2.48. That's how you get your payout ratio. You take the dividend per share, you divide it by the EPS. That's what gives you your payout ratio. So this is the scary. So this is what you want to consider. So here's the thing. If you're concerned about the dividend safety of Microsoft, you have to ask, well, is the payout ratio going to explode significantly where management is going to say, okay, this is out of control, we need to cut the dividend? Or are the earnings staying strong enough to support the dividend? Okay, that's the key thing here. And what you want to look at when you're looking at a business, all right, here, let me show this. If you're on the treadmill and you're watching this, what I want to take a look at is I want to look at the year-over-year growth in terms of percentages. And so I want to look at the EPS growth here in terms of year-over-year percentage growth. So the EPS has actually gone down a little bit for Microsoft. So you can see here during the 2021, it got up in the 40s. It was down here in June of 2020, and you can see here that it's slowly starting to slow a little bit, the earnings per share growth. Now, the other thing that you want to look at is here you can see the dividend growth rate, the percentage of the growth of the dividend. This is just another way of looking at it if you want to be nerdy and look at it from the income statement instead of just on a different website. So this is how you can view the dividend growth of a company on the income statement. Okay, so let me go and let me highlight one last thing. And I'm not going to do this in detail for every other company. I'm going to do it now so that you understand, so we're all on the same page. We're looking at the earnings per share, the earnings growth. We're looking at the dividend growth per share. We're looking at the payout ratio. What you want to see the dividend per share go up. You want to see the earnings per share go up. You want to see the payout ratio either stay the same or go down. Okay, those are the metrics that we're looking at. And really quick, if you want to look at this in a different view here, what you can do is you can go over to the growth tab here. You can scroll down and you can look at the compounded rate, the earnings per share growth rate of a company. This is something that's really interesting if you're concerned, okay, is this company going to cut its dividend anytime soon? Well, what is their EPS looking like? What is their revenue looking like? And, obviously the payout ratio. Okay, so that's the first thing. Now let's take a look and let's compare that with IBM. Now I want to be very clear. I'm not trashing on IBM by any means. I just want to compare it so that you can see when you're looking and comparing apples to apples of businesses, what company may be more inclined or more at risk to cut their dividend. Okay, so let's go look at the financials. Well, here really quick, before I forget, just so that you can see, the dividend yield for IBM is over 5%. Let me go back to Microsoft here really quick. The dividend yield for Microsoft is just over 1%. So bear in mind, this is a good comparison, but all we're talking about is risk of a dividend cut. Even if IBM were to cut its dividend by 50%, it would still have a higher current dividend than Microsoft. But when you're looking at growth rates and when you're comparing that 10 years into the future or looking backwards, that's where it tells a completely different story. Okay, let's take a look and let's go into the financials. Let's go into the income statement. We're going to keep the annual view here, and we're going to we're not going to look at percentages just yet. Let's go down and let's take a look at the basic earnings per share for IBM. This is looking at December 2012 all the way until the last trailing 12 months. So earnings per share, you can see that it is declining. It's going down pretty much. I mean, you see a little bit of a jump here in 2018, 19, but it's trending in the wrong direction. Okay, so their earnings per share is going down. Now let's take a look at their dividends per share. Well, that's weird. Their dividends continue to go up and to the right. It kind of reminds me of General Electric, but I don't know. Who knows? the dividends per share continues to rise. Okay, that's weird. Well, let's take a look at the payout ratio. The payout ratio is going up and to the right. The payout ratio is going in the wrong direction. So the earnings are going down, the dividends are going up, and the payout ratio is going up. All right, so this is annually year over year. Now, as I mentioned, if you're concerned or thinking that a company may cut its dividend, let's take a look at it quarterly. Let's see what's happening these last couple of years, and let's see where the business is at. Okay, so earnings per share are flat and going down. Like they're not seeing really strong earnings growth. And we'll look at it at a percentage here with percentages in just a second. The dividends per share, pretty flat. I mean, it's still growing just by a couple percentage points, but pretty flat. This is what's kind of scary, is the payout ratio is going up. The payout ratio is going up. Now let's look at this individually. So yes, we had the pandemic here in 2020, and you can see their payout ratio over 100%. Payout ratio over 100% in June of 2020. Over 100%, over 100%, over 100%, over 100%. It increased in 2021, over 200%. So what are they paying in dividends per share? They're paying $1.64 a share. They're earning only 82 cents a share. Now, this is maybe an extreme with March. Maybe this continues, maybe it doesn't. But let's look at this. Let's see December 2021. $1.45, they paid $1.65. So this is what a lot of dividend investors get wrong. They just look at the dividend. They think, oh, it's a great brand, IBM. When you look under the hood, the numbers don't look so great. So let's take a look. And once again, I'm not trashing on IBM. I just want to look at the numbers and see objectively what's going on here. Earnings per share growth. The earnings per share growth is inconsistent. Like you saw Microsoft was like in the 40%. The EPS for IBM is going down, right? It's going in the wrong direction. The dividend per share, bear in mind, once again, this is quarterly, has continued to go up slightly. The payout ratio is going up. So I don't know if you're concerned about a company cutting its dividend. You have to look at, what are the numbers showing? Earnings per share, year over year, they've done well in 2021, but compounded over 3-5 years. Revenue growth rate, I don't know. So if you're at this point, what you would want to do is you want to look deeper in their financial statements, their 10K, 10Qs, and really understand what is the management of this company doing to drive EPS growth. If they don't have EPS growth, they're not going to be able to continue to grow their dividend, and an ultimate inevitable dividend cut will come unless they fabricate it and artificially pay it through debt, selling off of assets. But as an investor, you don't want that. So you really have to look under the hood and understand, okay, what's going on here? What's going to happen? Because at the current pace, something has to give. Otherwise, I believe a dividend cut is on the horizon. So, but that's just looking at it from a very high level. You'd have to dig into the financial statements and listen to their earnings calls and see what the management says. Okay, let's go and let's look at this really quick. Let's look at waste management. Waste management, lower dividend yield. Let's look at the financials. And let's go into the income statement. Let's go under the annual view here from 2012. Let's look at the basic EPS growth. EPS growth is pretty healthy. It's pretty good. Earnings per share growth, you saw that dip during the pandemic, but they're continuing to grow their earnings per share. The dividends per share is continuing to grow. Dividends per share is growing very nicely. Payout ratio is, I don't know what was going on in 2013. There must have been an acquisition or something going on there. But you can see that their payout ratio, 50%, 92%, what's going on there, right? 60, 38, 41, 52, 61, 53. Let's look at this very quickly on a quarterly basis. Earnings per share growing at a healthy rate. Dividends per share growing healthy. Payout ratio. Payout ratio as of recent, since 2020, here has gone down. So this is a very good thing. So they're growing their top line. They're growing. We didn't look at their top line, their revenue. We didn't look at their revenue. All we looked at was their earnings. They're growing their earnings per share. They're growing their dividends, and they're decreasing their payout ratio. So I'm feeling pretty good about this company. Let's take a look at the growth here. We talk about top line. Top line, they're growing their top line as well. Diluted EPS. So you can reasonably expect anywhere from a 7 to 10. 10 is aggressive. 7 or 8% dividend growth rate for a company like Waste Management. Let's compare it with 3M. Now I want to be very transparent. I own 3M. I'm a shareholder of 3M. I own it in my M1 portfolio. 3M's been hit pretty hard, with trade wars and everything, and now with the legal lawsuits going on. But it's definitely on, let's look at the dividend safety here really quick. Dividend safety, it has a B. So if we look at the safety, it's got a B. I don't know if that's factoring in the lawsuit hanging over them. So I don't know. Let's take a look at the income statement. Let's see, what is 3M doing in terms of earnings per share growth? Okay, earnings per share actually looks pretty decent. The EPS for 3M looks good. Let's take a look at the dividends per share. Dividends per share is great, right? Now, once again, this is factoring in before trade wars, before pandemics, before lockdowns, before, they've always kind of struggled with lawsuits, but not like what they have right now. So we'll see. Payout ratio at a high level looks good, but once again, we're kind of concerned, are they going to be cutting their dividend in the future? Let's see what's happening there. Now, this is not going to be able to forecast lawsuits, but let's take a look and see how they're doing their financial situation. Financial situation, the earnings per share, look at that. What happened there? What happened in June? They were making over $2 a share to making 14 cents a share. I don't know what's going on there. It's probably a reason why their stock price is so low. Let's take a look at their dividends per share. Dividends per share looks pretty consistent. Payout ratio. I don't know what's going on here. Something's happening. Okay, so let's take a look at the payout ratio. 60%, 60, 59, 60, 52, 60, 56, boom, boom, and then boom. Okay, so what's going on here? If I'm seeing this and if I have concerns, are they going to cut their dividend? I'm diving into this a little bit deeper. What's going on? What's happening with this business? What's happening, right? And so I already mentioned what's going on, the lawsuits, trade wars, et cetera, pandemic, lockdowns, et cetera. So revenue growth for this company has been pretty slim these last couple of years, even the last 10 years compounded. There's a low margin of error here. So you can't really have a massive dip in earnings or revenue growth, though they do have a nice buffer with the payout ratio. Historically, it's been around 60%. So they did have that buffer, but you look at the earnings per share, I don't know. Like it's not looking too rosy in terms of EPS expansion, growth, and what is that going to mean for the dividend? Okay, so something to dive into. I don't know. You'd have to put a big question mark here. But when you're comparing Waste Management to 3M, it's night and day. But once again, I am acknowledging the dividend yield. Even if 3M were to cut its dividend by 50%, it'd still have a higher dividend than Waste Management. So, but the share price would get cut in half probably as well. So there's that. Let's look at SPGI, S&P Global. All right, so this is a financial company. Their dividend yield is very low, very, very low dividend, right? So there might be a trend here with low dividend yield and safety. So we'll see. Let's take a look at their financials. Let's take a look at the annual income statement here. What I want to look at is basic EPS. EPS is growing on an annual basis. You can see they're growing their earnings per share. Let's take a look at their dividends per share. Oh, it must have been really nice to be a shareholder of this company. They're growing their dividend. Your yield on cost, this is your yield on cost. If you invested here, at around $1 a share, you're getting paid about $3 a share now. Okay, so over $3 a share now. Let's look at the payout ratio. Payout ratio, very, very low. Okay, so they have a payout ratio similar to Microsoft, 28, 25, 26, 27, 24. I have no concerns whether or not this company is going to cut its dividend. They have such a low payout ratio. Their EPS covers their dividend per share 4 times. So I don't think there's any concern there. Let's take a look at the growth really quick. The growth, they're growing their top line, right, by over 10% compounded annually. Their EPS, they're growing over the last 3 years, 19, the last 5 years, about 10%. So you take that 1% dividend yield and you compound it by 10% each year, and you just do the math. How many years is it going to take you to get a 3% yield on cost, a 4% yield on cost? Okay, let's take a look at the last example here, Franklin Resources. This is a financial company. This is actually a dividend aristocrat. They paid a dividend for over 25 years. They have a dividend yield of around 5%. Let's take a look at the financials. Let's look at the income statement. Let's take a look at the earnings per share. Basic earning per share got crushed here during the pandemic. They were also kind of they're very interest rate sensitive. The Fed was hiking interest rates in 2018, so it doesn't surprise me there. I'd be curious, as the Fed is increasing interest rates now, what is that going to look like going forward? So let's take a look. Once again, this is looking at it annually. We'll take a look at it quarterly here in just a second. Dividends per share. As a dividend investor, if you just look at this chart, you're like, yahoo, this is great. Dividend growth, it's amazing. If you only look at this, you're deceiving yourself. You're not looking at the whole picture here, okay? The payout ratio. Payout ratio is also increasing. Earnings per share going down, with the exception of 2021. Earnings per share going down. Dividend going up. Payout ratio going up. Okay, so what's going on here? Let's take a look at this quarterly and let's see what they've been doing these last couple of years. Okay, earnings per share here. So during 2021, like everybody else and their dog, they made money. They did well during 2021. What have they been doing since December, March, June of this year? It's gone down. Okay, that doesn't look so great. Okay, all right, well, let's take a look at it. Their dividends per share have stayed consistent. They've actually increased. So they're increasing their dividend. The earnings are going down. What about their payout ratio? What's going on with their payout ratio? Payout ratio is going up. Okay, well, let's take a look and see, what has the payout ratio been doing these last couple of quarters? So back in 2020, December, it was at 39, 37, 32, 21, 31, 42, 57. So what I would be curious is looking at, okay, well, they're paying 29 cents a share. What is going to happen with their EPS? So their EPS was 86 a year ago. So last June, it's now at 50. What happens if it goes to 30? What if their earnings per share goes to 30? Well, what are they paying per dividend? Oh, well, they're paying 29 cents a dividend. Great. Well, what does that mean for the growth? What if in December, this goes down to 25 or 10? I don't know. I'm just humor me here. I don't know. I have no idea. But what if it does, well, then this company is in trouble. Then what they're going to have to do is take on more debt, sell off assets, all things that and many other things that could, the gymnastics, financial gymnastics that these CFOs, kind of go through with their. It really it begs the question, well, what happens? Are they going to be able to sustain this? Is this sustainable? Is the dividend safe? Well, at this point, it appears to be safe, but the Fed's not slowing down. Does this company, are they going to be able to withstand a year or 2 years, 3 years, who knows, of economic slowdown with interest rates rising where there are a financial investment firm? What's going to happen? So I have no idea. Don't read into this me saying, hey, sell this company. Like, I have no clue, right? I'm just saying if you're looking at any other company in your portfolio, these are the kind of things that you want to look at. You want to look at, is this company that I'm invested in, is it growing its top line, which this company is? Are they growing their EPS, which they have? But, looking at 2018, where the Fed was raising interest rates, what's happening, what's going on, it's a way to stay on top of your companies that you're invested in. If you are a nerd and you want to dig into this, what you can do then is you can say, okay, I'm concerned about this company. I really like this company. I'm going to do a little bit more research. I'm going to go and I'm going to read their quarterly statements. I'm going to see how they're doing. All of that, like, it just warrants more attention. okay? But just looking at the numbers is not the one and only way to measure dividend safety, right? That's what I was talking about with these dividend grades, right? Like, these are just numbers. It forecasts fairly well on whether or not the business, the numbers behind what the business is generating is sustainable or not. It also could depend on management, the direction that they take the company, all of those things. Nothing is ever guaranteed, okay? But when you're looking at the dividend safety, and if you're asking yourself the question, is this dividend safe? Well, look at the EPS, look at the earnings per share growth, look at the dividend growth, look at where their dividends, what is the margin of safety, what is the payout ratio? And that, in just a few seconds, a few minutes, you can uncover whether or not a company that you're invested in is safer, the dividend is safe or not. Well, everybody, this was a little bit of a nerdier video. I know that we saw a lot of information. I talked about a lot of different things. If you didn't understand half of what I was talking about in this video, I would encourage you, if you're invested into 100 individual dividend stocks, reconsider that. If you didn't understand half of what I said, I would highly encourage you to first start with index funds, start with low fee, broad-based index funds as your core. And if you want to then dabble and invest in individual stocks. And also bear in mind, even if you did understand half of this or all of it, that no one has a crystal ball, that even a great company can fail. History does not repeat itself, but it does rhyme. Thank you so much for watching. I hope that you learned something new, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.